Imagine living in a world where your money can do something absolutely mind-blowing. It can grow and multiply itself exponentially, leading you down a path to unimaginable wealth. Today, I've got something truly captivating to share with you: the incredible world of compounding. Brace yourself for an exciting adventure where we'll unveil the secrets of compounding and arm you with the tools to revolutionize your financial future. When it comes to personal finance, there's one concept that truly shines as a proven method for long-term wealth creation, and that's compounding. So, what exactly is compounding, you ask? Compounding is the process of reinvesting the profits, dividends, or interest earned on your initial investment, allowing them to generate even more returns as time goes by. The real magic happens when you realize that compounding not only earns you money on your original investment, but also on the accumulated returns. It's like a snowball effect, where your wealth starts rolling and growing faster and faster. To fully understand the power of compounding, let's take a practical example. Imagine you invest $10,000 in an asset that generates an average annual return of 8% over a span of 30 years. In the first year, your investment grows by $800, bringing your total to $10,800. In the second year, the 8% return applies to this new amount, adding another $864. Now your total is $11,664. As the years pass, the compounding effect begins to accumulate. By the end of the 30-year period, your initial $10,000 investment would have grown to approximately $100,626. That's an astounding increase. The best part is that the growth becomes even more significant over time because you're earning interest not just on your initial investment, but also on the accumulated interest from previous years. Now that we have a solid understanding of compounding, let's now explore the top 8 compounding assets that have helped make those wealthy individuals we admire today. Number 1. High-yield savings accounts. These accounts are like traditional savings accounts, but with a twist. They offer a higher interest rate, meaning more money for you. What's great about high-yield savings accounts is that they're super easy to get started with. You don't need a huge initial investment like some other options out there. Although the returns may not be as sky-high, they provide a safe and convenient way to compound your wealth. Let's break it down with an example. Say you deposit $10,000 into a high-yield savings account with an annual interest rate of 2%. Over 10 years, assuming the interest is compounded annually, your investment could grow to approximately $12,189. The compounding effect is what makes it happen. As time goes by, your interest keeps accumulating, contributing to the overall growth of your account. High-yield savings accounts are perfect for short to medium-term goals, or even as an emergency fund. They offer a safe place for you to preserve your capital while still enjoying the benefits of compounding. Number 2. Stocks. When it comes to compounding, stocks have a proven track record of outperforming many other types of investments over extended periods. Companies that consistently grow, boast strong financials, and have a competitive edge tend to deliver superior returns in the long run. By investing in a diversified portfolio of such fundamentally solid companies, you can tap into the incredible power of compounding. Historically, stocks have provided average annual returns of around 7 to 10%. Now let's get into the numbers. Imagine you invest $10,000 in a diverse stock portfolio, expecting an average annual return of 8%. Fast forward 10 years, and guess what? Your investment could potentially grow to approximately $21,589. Number 3. Dividend-paying stocks. Dividend-paying stocks are company shares that distribute profits to shareholders as dividends, offering potential for capital appreciation, regular income, and passive income, which makes them appealing compounding assets. Dividends are usually paid quarterly or annually, providing investors with consistent income. This income can be reinvested to buy more shares, accelerating the compounding effect. Dividend yields vary among companies, with higher yields indicating a larger percentage of the stock's price paid as dividends. Dividend-paying stocks can also appreciate in value. As the company grows more profitable, the stock price tends to rise, leading to capital gains. By reinvesting dividends and allowing shares to appreciate over time, investors benefit from compounding on both income and capital gains. To have a balanced approach to dividend-paying stocks, consider factors like dividend yield, payout ratio, and the company's financial health. It's wise to select well-established companies with consistent dividend payments and a track record of increasing dividends. Dividend aristocrats, companies that raise dividends for at least 25 consecutive years, are often reliable choices. Let's illustrate the wealth potential with an example. If you invest $100,000 in a diversified portfolio of dividend-paying stocks with an average yield of 3%, you can expect $3,000 in annual dividend income. Over 20 years, assuming an average annual stock price appreciation of 5%, your investment could grow substantially to $278,647. Number 4. Real estate. Real estate investments have proven to be effective for compounding wealth. Real estate, especially rental properties, generates consistent cash flow and tends to appreciate over time, presenting an attractive opportunity for compounding. The rental income from properties can be reinvested to acquire more properties, diversifying your real estate portfolio and increasing potential returns. Additionally, real estate investment trusts, REITs, offer a passive way to invest in real estate and benefit from compounding. For example, suppose you buy a rental property for $300,000 with a down payment of $60,000 and a mortgage of $240,000. Assuming this property generates an annual net rental income of 5%, $15,000, and appreciates at an average rate of 4% per year, the total return on your investment after 20 years could potentially exceed $700,000. By reinvesting rental income and holding the property, you can leverage compounding to accumulate significant wealth over time. Number 5. Bonds. Bonds are debt securities issued by governments and companies to raise funds, functioning as mutual funds. While bonds generally offer lower returns than stocks, they are considered safer investments. Bonds provide a regular income stream through interest payments that can be reinvested for wealth compounding. Additionally, bonds contribute stability to a portfolio and act as a hedge against market volatility. The compounding effect in bonds occurs when investors reinvest the interest payments, allowing the investment to grow over time. By reinvesting the interest, investors earn interest on their interest, leading to compounding growth. Let's consider an example where a person invests $100,000 in a bond with a 5% annual interest rate. The bond has a 10-year maturity, and interest is paid annually. Assuming the interest is reinvested each year at the same 5% rate, here's how the investment could compound. In the first year, $5,000 is received in interest payments, which is reinvested, resulting in a new principal of $105,000. In the second year, interest is calculated on the increased principal of $105,000, resulting in $5,250 in interest payments. The amount is reinvested, bringing the new principal to $110,250. The compounding effect continues for the remaining years of the bond's maturity. By the end of the 10-year period, the initial investment of $100,000 could potentially grow to a higher value due to the reinvestment of interest. Number 6. Precious metals. Precious metals have a proven history of retaining value and acting as a safe haven during economic uncertainties. While they don't generate regular income like dividend-paying stocks or bonds, their long-term value tends to appreciate. It's often recommended to allocate a small portion of an investment portfolio to precious metals as a safeguard against inflation and market volatility. The specific percentage allocation depends on individual risk tolerance and investment objectives. Typically, a common suggestion is to allocate around 5 to 10% of the portfolio towards precious metals. For instance, if an investor has a $500,000 portfolio and decides to allocate 10%, $50,000, to precious metals, they can consider purchasing physical gold or silver bars, coins, or exchange-traded funds, ETFs, that track the metal prices. Over a 20-year period, assuming an average annual return of 5%, the investment could potentially grow to approximately $132,676. As the value of precious metals appreciates over time, the investment can compound and contribute to overall portfolio growth. It's important to note that while precious metals offer stability, they may also experience price fluctuations. Therefore, experts recommend a long-term investment horizon of at least 5 to 10 years when including precious metals as part of a diversified investment strategy, rather than relying solely on them for wealth accumulation. Additionally, investors should consider the associated costs of storing and insuring physical metals. Number 7. Index funds and exchange-traded funds, ETFs. Index funds and exchange-traded funds, ETFs, are investment vehicles that mirror specific market indexes, like the S&P 500. They provide diversification across various assets, such as stocks, bonds, and commodities, enabling investors to benefit from overall market growth. These funds follow a particular market index, granting exposure to a collection of securities. By making regular contributions and reinvesting dividends, index funds and ETFs can compound returns over the long term, facilitating wealth accumulation. Historically, index funds and ETFs have delivered average annual returns of approximately 6 to 8%. Let's assume an investment of $20,000 in an index fund. With an average annual return of 7% after 20 years, your investment could potentially grow to around $67,275. By consistently reinvesting dividends and maintaining a long-term investment horizon, you can leverage the compounding effect to amass significant wealth. Number 8. Retirement accounts. Contributing to retirement accounts, such as 401ks or individual retirement accounts, IRAs, presents tax advantages and an opportunity for compounding growth. By consistently allocating a portion of your income to retirement accounts, investing in a diversified range of assets, and leveraging tax deductions, you can compound wealth within a tax-efficient framework. A 401k is an employer-sponsored retirement account where contributions are deducted automatically from your payroll, often on a pre-tax basis, reducing taxable income. For example, let's consider a person who earns an annual salary of $60,000 and contributes 10%, $6,000, to their 401k. Their employer matches 50% of their contributions up to 5% of their salary, providing an additional $3,000. Over 30 years, assuming an average annual return of 6%, the total contributions of $270,000 could potentially grow to approximately $831,211. On the other hand, IRAs are individual retirement accounts that you can open independently. There are traditional IRAs and Roth IRAs. In a traditional IRA, contributions are made with pre-tax dollars, reducing current tax liability. In a Roth IRA, contributions are made with after-tax dollars, and qualified withdrawals in retirement are generally tax-free. To illustrate, let's consider a person who contributes $5,500 per year to their traditional IRA for 30 years. Assuming a 6% average annual return, their contributions totaling $165,000 could potentially grow to around $527,625. Before we wrap up, let me share with you the exciting benefits that come with compounding. One major benefit of compounding is exponential growth. The earlier you start investing, the more time your investments have to grow and compound. Time is your ally, my friend. It allows the power of compounding to work its magic, resulting in exponential earnings growth. Even small investments can turn into significant wealth given enough time. Next, we have passive income. Compounding enables you to generate passive income. By reinvesting your earnings, you create a cycle of generating additional returns without actively working for it. This passive income can bring financial security and freedom as it continues to grow over time. Compounding also helps mitigate inflation. As we all know, inflation eats away at the purchasing power of money. However, investments that generate returns above the inflation rate can help preserve your purchasing power. It's like a shield against the eroding effects of inflation. Now let's talk about the psychological benefits. Watching your investments grow over time can instill discipline and patience. It reinforces the importance of staying invested and avoiding impulsive decisions based on short-term market fluctuations. This mindset is crucial for long-term financial success. Compounding is a powerful tool for building wealth. It can help you achieve your financial goals. Whether it's stocks, real estate, index funds, bonds, or retirement accounts, the key is to start early, diversify your investments, and reinvest your earnings to harness the power of compounding. Remember, compounding takes time, discipline, and a long-term perspective, but it has the potential to make you financially secure and even wealthy over time. If you found this information valuable, don't forget to hit the like button and subscribe for more enlightening videos. Here's to your journey towards financial freedom and compounding your way to a wealthier tomorrow.